All right, so we have Jeff and Charlie back from Intergy Wealth. Today is primarily focused on investing, although we are going to have a pretty large Q&A. So if you want to ask questions outside of investing that has to do with financial health, then you're more than welcome to do so. But we are going to focus on investing, the current market, very informational, but also the opportunity to learn and ask questions. So, turn it over to you guys. You have the mouse, you have your PowerPoint presentation, and everybody could thank Jeff and Charlie for coming today.
Thank you. I'm Jeff. This is Charlie. You guys remember, we're not offended if you don't. We're financial planners at Intergy Private Wealth, like Heather said. So just kind of building on what we talked about, whatever it was several months ago. Focusing is investing today, which if you are in a 401k plan, you're all investors already, you know, whether or not you think about it. So just really high level stuff there. And then again, leave it pretty open-ended for Q&A for whatever's on your guys' mind. It can be investing related or just big picture financial planning too. That sounds good. Cool. So, really big chart here. Who knows that the stock market is currently down quite a bit? Anyone aware of that? People. Yeah, 401k. Yeah, it's invested in the stock market, so it's down. So the market's down, and that's actually all hate logging into our 401ks and seeing down 25% or whatever it is around right now. But this is just a chart that kind of gives that some perspective. We won't zoom in too much because I don't even know how to zoom in on this PowerPoint, but if you go all the way back, it's 1934, $10,000 if you put it in 1934 and then just left it. The ending balance is about $246 million. Just doing nothing, you just put it in there and leave it. So we don't have that big a time horizon to invest. But the idea and what this mountain, if you will, kind of highlights, this is every single year, just so you can see the little bars. And the sliver there, it highlights basically the reason the world was going to end in that specific year, right? So 2008 with the financial crisis, it mentions Y2K on here, if you guys remember Y2K. The computers were going to take over, and that was it. All the way back, I mean, inflation, if you go back in the mid-70s, inflation, just like today, was a big deal. So every single year, you've always had a reason not to be an investor. You've always had a reason to be scared. That's kind of how the media, the news folks make money, right? They have to, after the commercial break, you have to come back for more. So they're going to tell you 10 ways to invest in the stock market so you can beat inflation after this break, right? You know, whatever it is to sell ads, that's what they're after. But no matter what it is, if you can just stay the course, eventually those little dips, I mean, 2008 is probably the biggest one on here. I mean, it's right here. If you just go straight up, it's a pretty decent dip. But even that kind of pales after several years, right? It goes away. So the goal here, yeah, there's scary things going on, weird stuff. You know, we've never been, I guess everything, if you look back historically, has happened in history, but it's not happened yet. So everything new is unprecedented, right, if you will. But it's no reason to change an investment strategy as like news cycles change, if that makes sense. So the fact your 401k is down 20%, so is mine. It's part of it. If you're not retired today, we probably should just keep putting it monthly, because eventually that's going to benefit us a lot more, if that makes sense. So anyone go in and choose your own 401k investments or any investment account where you actually choose specific funds instead of just the generic one?
So you guys did last time I changed.
Okay, maybe good, hopefully good, yeah. Well, that actually matters quite a bit. So here, this is talking about inflation specifically. So has everyone heard about inflation? Probably if you got in the grocery store the past month, fill up on gas. That's inflation, things are a lot more expensive. So 1979 was the last time that we had 10% inflation. We're not quite at 10% right now, but it's pretty dang close. So how do you outpace that? Obviously, you have to have money in savings and all that, emergency funds. We talked about that last time. That's not going to outpace inflation, but it's part of the plan. But for investing, should you worry about the stock market going up or down? Should you put your money in bonds? You've seen a gold commercial, right? If you've ever watched the news, gold loves the news, right? Because the news scares you, then they sell you gold, you know, in the commercial break. Not that it's bad, but it's just a funny thing. So, but how the $10,000, say 10,000 in 1979, you can see the difference in how those would have turned out, what you'd have at the end of last year, right? So if all you did was buy the 500 biggest companies in America, that's like Apple, Microsoft, NVIDIA, United Health, those type of companies, you'd have 1.5 million, right? It's not bad, that'll work. Probably be able to retire off that. If you listen to the gold commercial, right? Inflation's bad, the only way to beat this is put everything in gold. You would have $63,000, right? Again, it doesn't mean it's bad, but just, you don't want to think in terms of inflation's here, so what's the answer for it tomorrow, right? Or the market's here, so I'm going to leave it in cash, right? Look at your cash investor has $57,000, right? So how you choose to go in and click, like whatever funds you're putting 30% in, 20% in, that matters a lot over the course of time, right? Maybe a $1.5 million difference between cash and the stock market over that 4-year period, right? Make sense? Who's if you can read those names up there, who bought any of those stocks at some point in the past 2 years? Anybody else? You can admit it. You can admit it. All right. You guys are all perfect investors. I own some Zoom. Okay, I own one over here. That's fine. I have a fun account. I can buy some stocks. But look what happened. So this is the percent off all-time highs. Okay. So I should have almost done this prior. In the middle of COVID, you probably heard a lot about these names. Everyone was talking about them. Dude, if you just put all your money in DraftKings, you'll get 1,000% every year, right? It's like going to the moon, right? So that was great until the fall of last year, and that's when they all hit their peak. You can see them all kind of peak right there. And then here's those returns the past 9 months. Right, 80%, 90%, negative 87%. So if you put $100 in, you would have $9.70 if you put $100 into Robinhood last fall. Right, that's like crazy, right? So, if you a good analogy to this is the gold rush, 1849, long time ago, right? Ancient history, but a lot of people rushed because 3 people found gold on a river, right? Everyone headed out there because everyone was going to find gold. It's estimated that less than 10% of the miners actually came out wealthy. The majority of them broke about even, and then the rest of them, just under half, just lost everything, right? So yeah, some people made money in Zillow and DraftKings, and good for them, great. They got lucky because they picked it when it was low, or somehow they knew the future, and that's a really cool skill to have, but most of us don't. But most people that piled into these stocks piled in 2021, right? They heard, hey, Bob struck gold with DraftKings, so I'm going to put everything in DraftKings, and what they experienced, what we call performance chasing, and they're down somewhere in the realm of 80% plus, right? So as investors, when we choose to invest in something, when we figure out something that works with a plan, you just stick with it, right? Just because something did better last year or the past 6 months, that actually means fairly little the next 6 months, right? Especially when you talk about these companies, none of them even really make real money, so that's a whole other issue. But the point is, just don't chase what everyone's talking about, because it's probably, the shiny thing's probably not the right thing for you, right?
I'd be curious to get your feedback on something. I had a friend invest in cruise lines right when COVID hit off because everyone was avoiding the cruise lines, and he made the investment into there. Obviously, you had to ride that wave for a period of time, but now everyone's kind of getting back into the swing and it's rising back up. Would you guys ever consider like a method like that where you're riding a epidemic that affects certain channels, but I mean just overall, like as the United States that we come out of at the end, is that, like, do you think his method would make sense of him investing in that when it was dropping during that time period?
Yeah, so when you're making, it seems almost like obvious, like this stock's down, it's gonna go back up. Cruise lines are still really far down. and dropping. This year, they've been one of the worst performers actually of the year, along with airlines. That's neither here nor there, but when you're picking something, you're making a bet on the industry, the company, and then the time. So if you're comfortable being right on all three of those, and then on the flip side, you have to be still right when you get out. So there's a lot of things that have to go right. And at that point, it's gambling, right? It's incredibly speculative. You can be right, and it could work great. You could be wrong, and you could be, one of those. So it seems obvious, but name the point in time when cruise lines will finally recover from their pre-COVID levels. Which cruise line is going to go out of business and get acquired by one of the other cruise lines? All right, there's a lot of things at play. So just like no one apparently bought any of these, that's fine. You just have to be right, and you'll never hear about when someone's not right, because no one wants to tell you that they lost all their money on Coinbase. They'll just tell you the one thing they make money on. So it can work. It's just not a sustainable investment strategy.
It brings up a bigger point. So that general philosophy is called a contrarian investment philosophy, where you're buying things that are kind of down the most, if you will. But to Jeff's point, there's always more to the story, right? You could have said the same thing about the airlines, that they're also continuing to suffer. Obviously, fuel prices are a challenge. The labor market for them was a challenge. Our philosophy around individual stock investing is you in many respects have to do it with money that you can afford to lose. So like for a client of ours, we will not buy an individual equity position if you have less than $2 million invested. And we're not going to build like a very meaningful individual equity portfolio if you have less than $5 million invested, because we just don't have enough money to play with to do it well and be properly diversified. So it's, and that's like, I don't personally invest in individual equities. I use fund-based approach because it's more predictable, it works. I don't have to worry about it not working, right? Because that made all the sense in the world. Cruise lines got hammered, it's gonna come back sometime, but there's all these other factors at play that, even a relatively sophisticated retail investor, you don't know. So I think you can widen the lens a little bit though, and be successful in that. So like if you were to just take a broader approach to it, right? Like tech stocks, for example, right now. So there's plenty of index funds, mutual funds that track U.S. large cap growth or U.S. small cap growth, and they've just been decimated. I would feel pretty good about plowing some money into that, but do I want to pick which one of those unprofitable tech startups is gonna take a flyer? No, absolutely not. But if you collectively go in on the basket, then you've got a really good shot of coming out well on the other side. And I'm sure digital assets will come up at some point today too, and we could have a really similar conversation around that.
Another, I guess, last one on that is why you're investing. Most folks don't invest because they want to run a fund or be professional investors. They're investing so their kid can go to college or so they can retire or buy a house. So is thinking about Carnival Cruise Line every second of the day and whether it's going up or down, does that really aid in anything you're doing? Or can you buy an index fund and completely just piece out, focus on life, your kids, things that actually matter, and in 10 years you have your house down payment, or in 30 years you can retire? That's probably how more people are trying to live. So, and me and Charlie included. So, but here, this kind of dovetails that a little bit. Dollar cost averaging, anybody familiar with that term? Again, if you're using your 401k, that's all you're doing. Every paycheck, you have something withheld, 2%, 5%, 20%, and that is going into the market at that interval. So dollar cost averaging is saying, don't care about the market, don't care what it's doing. I'm just gonna buy the same thing in small intervals over time, okay? The best time to do it is actually the worst market conditions, even though that's the hardest time to withhold your 10%. So sometimes we get a question, a client calls in, hey, the market's kind of rough. Should I just change my 401k from 15 down to 8 until it gets better? Like, no, go from 15 to 18, right? This is the exact time you want to do more, even though it's a harder time to put your money in the market, right? So what this chart is showing is $100 every single month. And at the end, or really it was the beginning of this year when this chart ended, what would that $100 be worth, just given that the time period you're investing, right? If you look 2009, fall of 2009, your $100 would have grown to just over 600, right? And if you're familiar with just financial history, that was right at the bottom of the great financial crisis. The market, the S&P was down almost 40%, so twice what it's down right now, right? You think you were super excited to throw money in when you just saw everything else go down 40%? Probably not, but if you look back the past over 10 years, that was almost 100% better than any other investment period you had, right? Last 2020, mid 2020 was easy to invest, everything was going up. You're like, oh, investing's easy. I mean, you made 40 bucks, that's still not, I mean, that's still great, but it's not adding $500 to your contribution, right? So as part of this is, don't even think about this is gonna happen naturally if you just continue dollar cost average. But if you're thinking, oh man, the market sucks or it's really rough or the news is bad, well, keep doing it because realistically this is the best contribution that you're gonna make probably in the next several years or these past couple months, right? Because you're buying when the market's 20, 25, 22% down. It's a discount, right? If you're going to a store and your favorite thing is 30% off and you've been looking for it anyway, you're probably buying it, right?
Absolutely.
So you think Apple's a good company? Were they a good company in January? Probably. They a good company now? Probably. They're part of an S&P 500 index fund. Buy it up, right? 25% off. So that makes sense? Any questions on that?
I had just one thought around dollar cost averaging, something I'm sure you all are feeling with is inflation right now. So I think this is probably an appropriate time just to talk about some ideas around how to deal with that. The demographic generally, I think, of this company is feeling inflation a lot more than some other Americans are because it's all weighted, right? But like you're in that age range of, maybe trying to buy your first house, you're buying cars, you're going out more than like I will because I'm more old, boring. And so like you're feeling all of that, right? Like you feel the $20 martini, you feel like what it looks like to try and buy a car right now, or God, even worse, buy a house because the prices are still as high as they were a year ago and the interest rates have doubled. And so, one of we put out a newsletter at least monthly to our clients, and one of the things we addressed a couple months ago was, one thing to avoid during a time like this is living like nothing has changed. But finding a way to still dollar cost average is beneficial. You don't want to save at the expense of enjoying your life now. Like that's no fun. Like what good is having a stack of cash when you're 65 if you had to live like a pauper through the best years of your life? So you want to find balance, but adjusting your lifestyle to deal with a very real like economic change in all of our lives today is worth doing. So exploring ideas of whether it's saving on gas by commuting to work on a bicycle, or traveling with other people, or if you're going to the mountains, like try to carpool more so that you're not taking two cars, you're all piling into one. It is important. Like we do have to adjust. We were riding so high on the hog for so long. Money was effectively free. Low or 0% interest rates everywhere for so long. It's really hard to adjust like our spending habits and our thinking. But if you can make some adjustments, you don't have to shut off your 401k because everything is more expensive. It will pay huge dividends for you later in life. And if that ends up being something y'all want to delve into more, we're happy to. Like it is real. Like I recognize that. And depending on the stage of life, it affects you more than it might affect others or less. And that contribution going, taking advantage of the company match, at least at a minimum, will really benefit you long term.
We got anything? Any questions? This is the last thing we'll go through, and then we'll just open it up. This is going back to 1987, so it's just simulating a 401k or an IRA. So that first column is just the year. The second one is your monthly investment. $500 a month, 6,000 a year. So you just put 6,000 in every single year. Dividends and capital gains, those are two ways that you can get money in investment and grow. That's part of the way that those investments grow, which we can get into more. And then here is your total value of the account. Okay. So this is just the time frame is about the average working career. So it's something that it might not be too far off from what we're all trying to do right now. So 1987, halfway through the year, you start putting money in. So you put 3,500 in that year. It's worth 3,200, so you're down and you're wondering like, why am I doing this? This sucks. I could lose money at Cripple Creek way easier and more fun. We're on DraftKings now, you don't have to go to Cripple Creek, right? So, but you keep doing it, you 6,000, 6,000, 2,000, 2001, something called the tech bubble, and Y2K. So right there you can see your 243 by 2002 had gone down to 218, which sucks, but still noteworthy that you had 243, right? You put about $100,000 in at this point, so you've doubled your money. But still, you had to go through a period where you lost, on paper, $30,000, a little bit $30,000, right? That's no fun. But you were patient, you just kept putting into it. You're like, hey, that one Jeff guy said that one time, just keep going, right? You're like, cool. So you keep going. 2008, this is a real fun drop to see. So you're 445, you built up almost $500,000. And then in 2008, it dropped to $312,000. Right, so that's real tough, right? If you stuck through that, which would be good if you could, it'd be fun. Not fun, but within a couple of years though, by 2010, so that one took a while, right? 2020, if you guys invested through that, 2020 took 3 months to recover. So it's like we didn't even have a drop. You know, who knows how long we're gonna take here. We're 7 months into it at this point. But 2008, you would have had to wait almost 3 years to get all your money back, right? So that's a really patient, disciplined investor. But if you could, you would have had a rip-roaring decade right there, and you would finish, as of this last month, you would have 1.3 million, even though you only put in $210,000, right? So it doesn't start out as much. It starts out really slow. As a matter of fact, I don't know if I can go back, I can't go back. But your first couple years, there's probably like no growth that happens in the account, right? Because even if you have a 20% return and you just put $1,000 in, like you made $200, and that's not changing anything. So, okay, yeah, right there. So let's go, 4 years down. Right? So you're like putting in a lot of work and you're not seeing anything from it. So one concept to think of here is one, obviously if you can wait a while and just keep at it, you're gonna be fine, right? We have several like actual client stories where these folks never, you know, they weren't doctors or lawyers, they weren't making several $100,000 a year, they were just average folks, but they put in 10% in their 401k and they did it for 35 years and they'll be perfectly fine, right? They have nothing to worry about like ever again, right? So that can happen for everyone, just like us normal folks, right? But one thing early on, it's more, your contribution rate matters significantly more than the investment return, which is not super exciting. So even if you get 20%, or if you pick the cruise line stock and it goes to the moon off your $300 investment, 100% return on $300, you have $600. Like not life-changing in any stretch of the imagination. But if you can say, well, instead of saving 300, I'm going to save 600 months. I'm going to do that again. You increase your savings rate by 100%. And for the first decade of investing, that matters significantly more than your actual rate of return, if that makes sense. Eventually, your portfolio starts taking over. Your contribution's a small percentage of your account. And the portfolio, that 8% off 500,000 is a really big deal. That's more than you're putting in every year. But for a while, you know, if you're below a couple $100,000, your contribution rate probably affects that account significantly more than the actual growth of the account, right? The growth is helping and it'll add up over time, but the one thing you can't control is not what the market's doing next month or what it's going to do next year or in 5 years. It's, hey, I can, you know, maybe next year go from 6 to 7.5% of my pay, right? Or hey, I'll just keep doing 6 because inflation sucks. I'm just going to keep doing 6. right? That action you control affects your account a lot more in the first decade or so of investing. So yeah, that's about it. Pretty simple, straightforward, kind of high level, but we want to leave it open-ended. There's a lot going on in the world, stock market, economy. So whatever you want, if you want to talk about that stuff or just financial planning, just general information, we can talk about it. So we'll open it up. Any questions on anything?
So throughout my life, I've always felt as though paying down debt was my number one objective in any scenario prior to investing. I recently purchased a vehicle, and I have thoughts to where I'm fighting myself and getting these discounts you're talking about while the market's down, or paying off a car loan. Any specific thoughts around that?
A lot of it depends on the interest rate. I mean, generally we advise, anybody, regardless of your financial situation, to avoid high interest debt. So, anything, I don't know, north of 6 or 7%, I would consider high interest debt. It's credit cards and stuff like that. So, but a car is usually market rate debt and or low interest. So, let's just say you could conservatively earn 7% in the stock market, and your car loan is 3.5%. Doesn't make a whole lot of sense. I get the urge. I've had the same urge myself. It's like, I don't like this car payment, I want to pay it off. But it's at 0% or it's at 1.9 or it's at whatever. It just mathematically doesn't make any sense. So it's usually a both and. We're sitting down with our clients and advising them on, debt service versus savings. It's a balance of making sure they're saving enough, but also like there's like an emotional component to paying down debt that feels good. And feeling good is important, right? It's part of just like enjoyment of life. So I don't have a definitive answer for you, other than if it's below, 6%, probably don't do that. If it's higher than 6% interest, like maybe do it.
But I shouldn't feel crazy if I still want to invest at this point.
No. I mean, I'm literally like scouring for dollars to put into the market right now, above and beyond the normal contributions that I would make. It's unfortunate that interest rates have gone up because sometimes I've even used like a personal line of credit to invest. It's not something we broadly advise. You have to tread, on that carefully and know that you can pay that debt off quickly. But yeah, I mean, the power of investing during down markets like this is incredible. One other thing I'll add before we jump to some more questions, I think, the news and media just reports on the price of the investments. And I think that leads the general investing public to start thinking about like, oh, buy low, sell high, type of mentality, right? Like, gonna try and time it, think that's how you're gonna make your money in the market. It's not. Like, because what they don't tell you about is the dividend income. So that's kind of line item there. The easiest way that I have found to explain it, I hope that this lands, is thinking about it like almost like a rental house. Like, let's just say you owned a rental house and it was paying you interest every month. Like, if you had the ability to take that rent, your interest, and put it back into your house, and that made your house bigger so that your next rent check was bigger, that's how compound interest works. And that's what happens with stocks, right? They pay dividends, those dividends get reinvested. They're getting reinvested at depressed share prices now, which is awesome, because even if you don't have a new dollar going in, you have a dividend coming back in and buying more shares, and that makes your next dividend payment bigger. And it takes a really long time for that flywheel to like really start to spin. But when it does, like, it's just gross how like, and that's why you'll see, like, as you kind of follow that, if you look at the value of that account, and as those dollars start to get bigger, the dividend payments get bigger. And so that like compounding effect just gets, it's pretty dramatic long term. But you have to like just suck it up through times like these, which kind of suck, honestly. Like, I don't like it. I hate it when I open up my phone and like all the numbers are red. It's annoying. Especially when it's been kind of persistent, right? Like, we've been in this for what, 7, 8, 9 months now? It's getting old.
So in your opinion, like, minimum, what should we be investing off of every paycheck percentage wise? Like, is 5% too little? Is 10% the right number? I mean, you guys know what it is, you guys got bills and stuff like that, so like, a normal average Joe, what do you think is a good percentage to be throwing into something like a Roth IRA?
Yeah, I mean, savings rates, if you're between 10 and 20%, most goals that you can make that are several years out, you could probably, realistic goals, if you're making $50,000 and you want a $500,000 car in 3 years, like that's just, those numbers don't work, right? But hey, I want to retire in 30 years making $50,000 a year because that's what my lifestyle. If you're doing between 10 and 20%, and that's probably cash savings, 401k, brokerage account, you're probably going to be in the ballpark. That's a kind of a subjective answer because some people want more, want less. At a minimum, I know there's a match here, so that should be like a minimum goal for everybody, no matter what you're doing, budget to match, because that's 100% return immediately. Once you invest, you get that doubled by the company. But above and beyond that, it's kind of subjective, but if you're in probably the 10 to 20% range, most things you want to do when you run the math and project it out, you're probably going to be close.
The earlier you can build that habit, the better. Because if you build a habit of percentage-based savings, when you're making modest wage, as your wages grow over the course of your lives and careers, it's so much easier to kind of make sure your savings rate is still in line with your lifestyle need. Because it's all kind of scales, right? So if you need to save 10 to 20% to basically duplicate your current lifestyle in retirement, when your income doubles, triples, quadruples, wherever y'all are headed in life, it's that much easier. A lot of folks will kind of delay that. Just say, I'll save when I make X. And then our lifestyle just keeps like bumping up against our income. I've seen it happen hundreds of times. It's happened, I've seen it happen in my own life. So if you build the habit earlier, it's a lot easier later on.
Say, let's say you've been just like in your 401k for 10 years and comes time you want to buy a house. Do you then borrow against your 401? Like, how do you go about that? You keep that the same?
Yeah, unless that would be
But does it leverage anything at that point? Like, does your, profile or whatever as a money-making person, does that mean anything to you as the leverage to get a loan percent?
generally speaking, no.
No.
You could loan against it to get something. And that just becomes a matter of planning. If you're trying to buy a house, if you're getting the match and put an extra 5% in your 401k, what if you scale back 2% and then open a brokerage account that invests the same way, but you can fully liquidate in 8 years, right? No penalty, no loan against. That would count if you're trying to get a loan and say, hey, I have a $25,000 brokerage account. A lender will say, yes, cool. You're using the money for the down payment, or you just want us to know it's there, but it matters. A 401k, one, it probably won't matter, and two, you really don't want to touch it because its job is to do something completely different. So if you had something else in mind for the money, the 401k was probably the wrong place for it to begin with, if that makes sense.
It does.
We speak a lot of 401k because it's like a common ground that everyone in the room, like we all have 401ks, we all can match, like we all can at least start there and then go somewhere else. So
There's also some risks with the loan that a lot of people are not aware of. Like if you quit your job or you get terminated, your loan effectively becomes due immediately. In all likelihood, you don't have the cash to pay it back, so that it's then going to get treated as a taxable distribution from the 401k plan, also subject to an additional 10% penalty. So let's just say you took a $10,000 loan from your 401k to help with the down payment on a house. You quit your job, you're terminated from the plan. All of a sudden, you owe the IRS on taxes due on $10,000 of income plus a $1,000 penalty. And you have no control over that, right? Like you don't, just whatever, layoffs, or you get a better opportunity and you just, so it's just, we just don't recommend it. We've seen people do it. It's just really not advisable.
Yeah, I knew you weren't supposed to touch it, but I was just wondering if it leveraged anything in the package.
No.
yeah, not really. I would just plan accordingly, and if you want to invest for something like that, get a brokerage account.
Kind of piggybacking off that question. If you were currently trying to save for a down payment on a house in say 5-10 years, where would you park the money?
5-10 years, that's where something like a brokerage account or a non-qualified account.
Just parking an index fund type.
Yeah, you could, or even if you want to think less about it, you could buy a target date fund. A lot of people structure those for retirement, but I want to buy a house in 2045. Open a Vanguard brokerage account and buy the Vanguard 2045 fund, and it will automatically allocate you out to that time horizon to get safer as you get closer. Which, when it's time to start house shopping, you probably want cash, not an index fund at that point. So it kind of, it can take care of it for you. If you're on top of it, you check your stuff once a month, twice a month, and buy an index fund and make sure you're adjusting it as time goes on.
Generally, target date funds will exchange index funds or equity for bonds.
For bonds over time as it gets closer to that date.
Yeah, and bonds are kind of an interesting subject right now. Do you have any thoughts around bonds?
If you need, so the purpose of bonds for retirement savings for most of us in this room, they're probably fairly irrelevant right now. I might have a little bit, but what they do is provide income. Certain bonds can help target inflation. There's inflation protected bonds, and they also, when you're looking at what we consider a lot for older clients or for clients that are needing liquidity soon, is volatility, and bonds dampen that. So even if you hate them because they don't provide a lot of return, which is true over time, what they also don't do is have a very wide deviation. So they won't skyrocket by 50%. You're probably not going to see a 75% decline in a government bond, right? You might see a 6%, and that still kind of sucks. But if the market's down 30, I'll take a -6 over that, right? So the purpose for something like that would just be, as time gets closer, the potential outcomes of your house down payment fund would narrow, right? In an index fund, you're going to have, it could keep getting 20% a year. It could go down 20% for 3 straight years. Yeah, I don't want my house down payment fund doing that the year I start house shopping. So that's, whether you love them or hate them, you're probably going to use them at some point in your life. So,
Fair. Thank you.
If you don't want to, you just have to be willing to, delay your purchase, right? Like if you were in all stock portfolio right now, you're in worse shape than if you had a stock bond mix and you wanted to buy a house. And the other piece on that is, somewhere in the range of 12 to 24 months out from when you really are going to make the purchase, go to cash.
That's when you're de-risking.
Yeah. I mean, and generally we don't invest money that's intended to be spent within the next, I would say 12 to 18 months is maybe a little bit more of our kind of internal rule of thumb, because the risk just isn't worth the return, especially on a critical purchase, right? So like for a retiree, obviously they absolutely have to have that money. So we can't, have money that we know is going to be spent 3 months from now at risk. And that's what has allowed our clientele to be, effectively totally calm throughout this whole correction. It'd be the same principle would apply to a home purchase, big vacation, right? Like you're going to take a month vacation to Europe, right? So that's a savings event. You're going to save up for a couple of years for something like that. So.
Are you two currently investing in?
You gotta pay a fee for that. I'll start with that. I don't own bonds because I have a pretty long time horizon. I'm 42 next month, so I've got 20, 25 years before I plan to retire. So I invest in the exact same things we put our clients in. Literally the exact same portfolios. It's a mix of index funds and actively managed mutual funds. Jeff does a lot more goofy stuff.
I have an account that I fund in and lose money typically. No, it's you win some, you
I'm
lose
not
some.
just talking about Coinbase.
That's you don't win them all. So my planning money is just in index funds. I'm all equities right now too.
I somewhat prescribe the bobblehead theory of investing, which is basically a percentage of bonds, percentage of international index funds, and a percentage of U.S. index funds. Do you have any thoughts around U.S. versus international index funds at the moment?
Buy them both. They're great. When one, they'll typically move together We don't have to get super nerdy here. Some call it correlation. That just means they move together. When US goes up, international will go up. Vice versa. When they go down, they go down. You don't really gain anything that way. Where you do hedge risk, or maybe gain some diversification, is different companies exist in Europe that don't exist here. Every time you see a Volkswagen car, that's money that's a European investment, not a US one, right? So good companies exist around the world. You're not, you don't have to be all crazy thinking, hey, I don't want any China or Germany's or crazy, who cares? There's good companies in China, good companies in Germany, good companies in Spain. That's what you're buying. And the last thing, which is really more nuanced, is currency rates, exchange rates. They've been in the news a lot lately. The dollar and the euro are 1 for 1 right now, which is super cool. So we have an easy time going to Europe now because we can just pay for it. We don't have to do some weird math to come up with how much we owe. But when the euro or any foreign currency does better, what that means is international will do a lot better. Because when money gets translated back in, it's coming from a higher denomination to a lower one. So you also hedge how currencies change over time just by diversifying internationally. So own them both. We're primarily US, but you should definitely have a sliver. If you own a target date fund, don't worry. They got you, you're good. You have US international, they own it all. But if you're picking it out, yeah, it's definitely a great idea to diversify that way.
Thank you.
How much is too little to start with? Like, if you wanted to, let's say I wanted to talk to you, what would be the initial investment to get something started? Like, how much is too little?
Yeah, well, we're probably going to charge you too much for what it's worth.
Yeah.
For real, just if you're like, hey, $100, you're like, well, all right, we'll take it all, and then you don't invest anything. Just kidding, kind of. Good places to start though, your 401k, because it has some really tight guidelines. It's hard to mess up a 401k, as crazy as that sounds. You could probably do some things that aren't perfect, but you can't blow yourself up. Outside of that, great tools are what's called robo-advisors. These are online tools with no minimum and usually fees that are minuscule. You're probably not going to get tons of financial advice, but if, hey, I want to invest for a 10-year time horizon, they're going to send you, you sign up for a Betterment account, Wealthfront account. SoFi has the same thing. They'll ask you 10 questions. What's this for? Oh, it's for a house in 7 years. Great, here's how your portfolio should look. Every time you put $100 in, we'll make it look like this, and there's nothing you can do about it. You literally cannot blow this thing up because we're making sure that you do this, right? Or hey, I'm saving for retirement, IRA. Great, ask you 10 more questions. This is how your portfolio is going to look. And it's just, again, it's a way of establishing guardrails so you can't say, oh, I'm buying an index fund, and oh, I heard a worth at Coinbase was awesome. Here, instead of an index fund, start buying Coinbase every month, right? And there goes your cost fund. So yeah, I would say that's probably a good way to get started. Between your 401k, anything that you don't want for retirement, look for one of those robo-advisors because it's really, really cheap and it provides those left and right limits.
That's great.
Betterment and
this
Wealthfront.
is good information, but if there's
No way to
string
do it.
along and no way to use
Yeah.
it.
Yeah, so like for something we talked about, a house goal in 10 years, right? That's something you should probably invest for.
Absolutely.
Again, Betterment, Wealthfront, SoFi, there's some Schwab, Charles Schwab has one. You go there, open up the account, tell them what you want. Again, it's gonna have it for you where you can't mess it up, just listen to what it says, right? So yeah, it's probably, hopefully it helps.
Yeah, it does. Thank you. That's probably helped more than I.
Okay, good.
I'll add to that and be a bit more specific. So, like, we have a hard minimum at $500,000 to invest with our firm and have us manage it. We do work with people who have less than that to invest, and we charge an additional planning fee to make up the difference. And we're not trying to be arrogant or on our high horse or anything, but as we've looked at our own business metrics, like for us to provide good service that we feel good about, that's kind of where the fee has to be. But we have folks call in that we'll just do a phone call with, and just say, hey, what do you need? And sometimes the result of that phone call is you don't need to pay us a fee. You don't need to invest with us. Do this and call us. Like when you need us. And remember that we gave you really good advice for free, and hopefully you'll remember that down the road. Sometimes folks, they don't necessarily have any money to invest yet, but they want to pay like a monthly subscription fee to have access to one of our financial planners. And we do that too. So, but I think the important thing to know is like, we'll just tell you, if you don't need to pay us a fee, like we'll just tell you. It's, you know, I'm more than happy to just, you know, give back and just give people good, honest advice, because everybody's at a different place in their life. And if you don't need sophisticated planning, then to Jeff's point, using an investment solution like a Betterment or a Wealthfront is a good solution. There's a lot of people using those solutions that should be using a planner like us, because there does become a tipping point where making mistakes can get pretty costly, or when your financial situation becomes complex enough to need more like dedicated, ongoing advice. So I just didn't want to like answer specifically what you had asked us.
That's great.
Can you guys share those sites with me in an email so I can share it with
Yeah. I mean, even if you Google top robo advisors, I mean, we'll share the specific ones. If you just Google top robo advisors, those at least 4 and probably 3 more that I didn't think of will show up. They all do the same thing. And again, the big goal there is to keep yourself out of your way. Now, hey, I should invest. I don't exactly know what to pick. How can I do it for as little cost possible? So.